Good morning, Martin. Well, I think it's fair to say that we're definitely expecting lower rates of growth from economies around the world. Obviously, we have the energy crisis in the Eurozone. We've got policy errors potentially coming through in the US, and that's weighing on sentiment. And also, we've got the restrictions in China. I think there's a better case to start off and saying, with all of that happening, the economy has been remarkably resilient. We're still seeing consumers that are willing to spend in this environment. If we look at the retail sales numbers, we're still seeing some momentum come through. If we look at the manufacturing numbers, although they are softening. And we're still seeing good intentions by companies to spend in capex levels in this environment. And that does point us towards a continuing growth environment, even if it is going to be at lower rates than we expected just at the start of this year. I mean, as the economy does slow down, the probability of recession does rise. But we do think there's enough momentum at the moment and not any of those really large structural imbalances that would typically cause a recession in the past. So it is very much focused on monetary policy to a large degree.
Yeah, and monetary policy obviously to fight inflation. So what are the chances, and I know you think the price pressures are going to moderate. What's going to cause that?
We are looking for an eventual reopening of what's happening in China. That'll ease some of the supply chain pressures. We've already seen that shift around the world from spending on core goods, which was one of the demand pressures on supply chains from last year, start to shift towards services. And we think that'll be an important aspect of the services PMIs that come out this month. And that should helpfully alleviate some of those pressures. We don't expect them to completely go away or reverse, but we think that will take some of the heat out of that concern for investors and probably some of the heat out of the inflation numbers as we look over the course of this year.
I know, and you and I were talking offline a couple of seconds ago before we went to air. You were expecting or thinking that, one big offset to this whole recession story would be if China were to come up with a huge guns blazing sort of stimulus package. What are the chances of that, and what would it look like?
Well, China's is a very delicate position. I mean, they're trying to pursue this policy of controlling the spread of COVID, the zero COVID policy. They're trying to delever their economy when it comes to the housing market, and at the same time achieve that 5.5% growth target for this year. That trifecta of things doesn't seem like something that's going to balance out easily, and something we'll have to give. And so really to offset that, we're going to expect to see more targeted stimulus measures. Again, once there's more movement of people, once the restrictions come off around Shanghai and hopefully Beijing, you're more likely to see fiscal stimulus come through, allowing people to spend money in the economy rather than just spending money at home and potentially adding to those inflationary pressures in food and certain goods. And we're also likely to see further easing around the housing market, maybe changes some of the tax rules that come through. We've already seen that 5-year loan prime rate cut, which is obviously going to help that. But we think there'll be more done to try and ease some of the pressures around the housing market with the long-term view in mind that they are trying to increase that deleveraging. Again, I think it'll have to be in a much more managed way than perhaps the more heavy-handed tactics we've seen so far if they are trying to achieve that 5.5% growth rate.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.